Welcome to week 7 of FABM 2, our topic financial ratio analysis. What is ratio analysis? Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and income statement. What does ratio analysis tell you? Investors and analysts employ ratio analysis to evaluate the financial health of companies by scrutinizing past and current financial statements. Comparative data can demonstrate how a company is performing over time and can be used to estimate likely future performance. This data can also compare a company's financial standing with industry averages while measuring how a company stacks up against others within the same sector. Investors can use ratio analysis easily, and every figure needed to calculate the ratios is found on a company's financial statements. Ratios are comparison points for companies. They evaluate stocks within an industry. Likewise, they measure a company today against its historical numbers. In most cases, it is also important to understand the variables driving ratios as management has the flexibility to, at times, alter its strategy to make its stock and company ratios more attractive. Generally, ratios are typically not used in isolation but rather in combination with other ratios. Having a good idea of the ratios in each of the four previously mentioned categories will give you a comprehensive view of the company from different angles and help you spot potential red flags. Let's learn more about ratio analysis. Ratio analysis is used in accounting, finance, and marketing departments in order to make more well informed decisions and reasonable forecasts. Uses of ratio analysis vary from creating common size accounting statements to determining the business's inventory turnover or tracking the success of a marketing campaign over time. Uses of ratio analysis include breaking data down so that it can be compared. Comparing ratios over time can help a business make reasonable predictions about what it should expect in the future if conditions remain the same or similar. Breaking data down to ratios and comparing the ratios over time can also help businesses see if trends or cycles emerge. Standard ratios have been developed to accomplish certain types of analysis within different areas of business. For instance, in finance, it is common to use the earnings per share, gross profit margin, return on assets, and inventory turnover ratios. Not only does this help a business in comparing historical data between itself and competitors, but employees are generally trained in using this as specific ratios before being hired. Even though most ratios are easy to compute, the analyst must understand the significance of each ratio in order to avoid making false assumptions. Dangers of using a ratio analysis include not understanding the assumptions made in its calculation, taking into effect price changes, or using data that may be incorrect. Uses of ratio analysis are important in analyzing the business's data, but they can result in incorrect or misleading calculations. Limitations of the uses of ratio analysis should not prevent businesses from using them, but they should make businesses take more caution before using them in making decisions. Ratio analysis is important for the company in order to analyze its financial position, liquidity, profitability, risk, solvency, efficiency, and operations effectiveness and proper utilization of funds, which also indicates the trend or comparison of financial results that can be helpful for decision making for investment by shareholders of the company. It helps us to compare the trends of two or more companies over a period of time. Importance and uses of ratio analysis. Number one, analysis of financial statements. Interpretation of the financial statements and data is essential for all internal and external stakeholders of the firm. With the help of ratio analysis, we interpret the numbers from the balance sheet and income statements. Number two, ratio analysis helps us in understanding the profitability of the company. Profitability ratios help to determine how profitable a firm is. This ratio basically tells us how well a company uses its investors' money. Ratios like the gross profit and net profit margins. Margins help to analyze the firm's ability to translate sales to profit. Number three, analysis of operational efficiency of the firms. Certain ratios help us to analyze the degree of efficiency of the firms. Ratios like account receivables turnover, fixed asset turnover, and inventory turnover ratio. It measures a company's capability to generate income by using the assets. It looks at various aspects of the firm, like the time it generally takes to collect cash from debtors or the time period for the firm to convert the inventory to cash. This is why efficiency ratios are very important, as an improvement will lead to a growth in profitability. Number four, liquidity of the firms. Liquidity determines whether the company can pay its short-term obligations or not. By short-term obligations, we mean the short-term debts which can be paid off within 12 months or within the operating cycle. Current ratio, quick ratio are used to measure the liquidity of the firms. Number five helps us in identifying the business risks of the firm. One of the most important reasons to use ratio analysis is that it helps in understanding the business risk of the firm. Calculating the leverages, financial leverage, and operating leverages helps the firm understand the business risk. An example, how sensitive the profitability of the company is with respect to its fixed cost deployment as well as outstanding. Number six helps us in identifying the financial risks of the company. Another importance of ratio analysis is that it helps us in identifying the financial risks. Ratios like leverage ratio, interest coverage ratio, DSCR ratio, etc. helps the firm understand how it is dependent on external capital and whether they are capable of repaying the debt using their own capital. Number seven, for planning and future forecasting of the firm. Analysts and managers can find a trend and use a trend for future forecasting and can also be used for important decision making by external stakeholders like the investors. Number eight, Number eight, to compare the performance of the firms. The main use of ratio analysis is that the strengths and weakness of each firm can be compared. The ratios can be also compared to the firm's previous ratio and will help to analyze whether progress has been made by the company.